it might be that the shift is now moving towards a programmable collateral, and I'll explain why. So I think the appeal at this particular point in history is definitely clear in that a holder is now able to effectively unlock liquidity without immediately selling their Bitcoin. But I think we always need to pay attention to the fact that the risk is equally clear in that once Bitcoin supports debt obligations, a market decline can become a margin call, a forced kind of collateral transfer, liquidation, or a tax event, a counterparty loss, and also a wider leverage cascade, right? And I think the most important lesson that I would take away from that is the fact that the platform's maximum LTV is not a responsible borrowing target, right? A borrower should always ask what LTV can survive a 40 to 60% Bitcoin decline, which is typical in Bitcoin cycles, requiring without actually requiring kind of an emergency transfer or refinancing or a forced sale. So I think Bitcoin at the end of the day can become more financially useful, but that doesn't make debt safe, right? The future of these Bitcoin-backed credit markets will depend on transparent custody, conservative LTV design, as well as kind of just having those predictable liquidation and limited hypothecation. And I think that's really what will make it maybe a much more of a credible and sustainable capital market.